Welcome to this explainer. Quick question for you. Have you filed your income tax return yet? Because if you haven't, you genuinely need to stop whatever you're doing right now and listen up. Today, we're breaking down the absolutely critical July 31st deadline for assessment year 2026-27. Every single year, millions of taxpayers miss this crucial date, and the financial consequences they face, well, they go so much deeper than what you might read in some quick news headline. We're going to look exactly at what happens to your hard-earned money the second the clock strikes midnight on July 31st. Okay, let's dive into this because this idea right here is probably the single most dangerous misconception floating around out there. A lot of people think, so what if I'm a little late? I'll just pay a small fee and move on with my life. No big deal. They treat the deadline like this minor inconvenience. But as we're going to see from the data, treating July 31st as a soft suggestion rather than a hard, non-negotiable rule triggers this massive domino effect of financial penalties. And the worst part? Most people are completely blind to it until the tax department actually comes knocking at their door.
Because here is the harsh reality. Missing that deadline doesn't just mean a tiny slap on the wrist. It could quietly cost you tens of thousands of rupees. The penalties and the lost benefits compound in ways that financial creators honestly rarely talk about. Once that July 31st window closes, some of your biggest financial benefits are literally gone forever. Today, we're going to walk through the 6 distinct costs of missing the deadline. And I promise you, by the time we hit the third one, you're going to be rushing to get your paperwork sorted out.
So let's start with the most obvious one, the late filing fee under Section 234F. Looking at these penalty tiers, you can see the fee scales directly based on your income. If your total income is above 5 lakh rupees, you're looking at a flat 5,000 rupee penalty the absolute moment you file late. Boom, just like that. Now, if your income falls between 2.5 lakh and 5 lakh, that penalty drops to 1,000 rupees. And if your income is below the basic exemption limit, say below 3 lakh under the new tax regime, your penalty is actually nil. But hey, do not let that zero fool you, because as we're going to see in a second, avoiding a flat fee definitely doesn't mean you avoid all the trouble. Which brings us to cost number 2. And it's driven by this single, incredibly intimidating number, 1%. This is Section 234A interest, and let me tell you, this is where the financial bleeding really starts. If you have any outstanding tax due, you get hit with a 1% simple interest charge per month for every single month you delay filing. I know, it sounds small, right? But let's actually do the math. If you owe 50,000 rupees in outstanding tax, a 1-month delay quietly balloons your bill by 500 rupees. Push that delay to 3 months? That's 1,500 just in interest, stacked right on top of that 234F penalty we literally just talked about. Now, what's really interesting about this slide is that it reveals the absolute biggest hidden cost, especially if you're an active investor. This is cost number 3, the total loss of carry-forward benefits. Normally, if you take a hit in the stock market or on your mutual funds, the tax system lets you carry that capital loss forward to offset your future gains. It's a great safety net. But look at this comparison. If you have a 2 lakh rupee capital loss for the year and you file on July 31st, you can use it to reduce your future taxes. But if you file on August 1st, that 2 lakh loss is permanently gone. You cannot use it to offset future gains. Just 1 day delay literally wipes out your tax shield. Okay, I'll give you a brief moment of relief here. There is exactly one exception to this brutal rule. As the tax provisions explicitly state, house property losses up to 2 lakh rupees are the only exception and can still be carried forward even if you're filing a belated return. So if you took a loss on your real estate investments, you are protected. But for short-term and long-term capital losses on equities, that door slams firmly shut at midnight on July 31st. So we've got the flat penalty, the compounding interest, and that devastating loss of capital carry forwards. But let's look a little closer at costs 4, 5, and 6, because honestly, these are just as damaging. Fourth, if you're operating under the old tax regime, filing late entirely strips you of essential business deductions. You lose the ability to carry forward any losses from a business or profession to offset your future profits. Fifth, your margin for error completely disappears. When you file late, you lose the right to file revised returns after December 31st, meaning any tiny mistake you made becomes permanent. And finally, cost number 6 hits you when the government actually owes you money. If you're due a refund because of excess TDS, filing late shoves you to the absolute back of the queue. Your refund is delayed, and to make it even worse, you lose out on the interest the government would have paid you on that money. With stakes this high, we really need to bust some of the most common myths that get taxpayers into massive trouble. First up, I'll just pay the penalty later. Well, now you know you're also throwing away your carry-forward losses. Then there's no income, no need to file. Guys, this is a massive trap. If you have bank accounts, fixed deposits, or investments generating TDS, the income tax department's automated systems are going to flag that mismatch, and you could get hit with a notice under Section 139(9) or 148. Filing a nil return is your absolute best defense. Also, relying on the whole "the government always extends the deadline" idea? Terrible strategy. Betting your financial health on a rumor is never, ever a good idea. Extensions are never guaranteed. And hey, for anyone watching from overseas, pay close attention to this one. Non-resident Indians often wonder if geographical distance gives them a free pass. It definitely doesn't. If you're an NRI with Indian-sourced income, whether that's rent from an apartment in Mumbai, capital gains from the Indian stock market, or even a salary for work done in India, you are bound by the exact same July 31st deadline. The penalties, the compounding interest, the loss of those carry-forward benefits, they all apply to you just the same. All right, so if you're watching this and realizing, oh no, I've already missed the date, just take a deep breath. It's okay. We've talked about the damage. Now let's actually talk about the solution. How do we stop the bleeding? You need to file what's known as a belated return. The tax department completely understands that people make mistakes or, just procrastinate, so they do give you a second chance, albeit a penalized one, to get your books in order. And trust me, a belated return is infinitely better than filing no return at all. Let's move to and see how this builds over the rest of the year. Mapping this out on a timeline reveals a pretty rigid schedule. On August 1st, 2026, the late filing period officially begins, and that 234F penalty kicks in immediately. But here is the critical date you absolutely cannot ignore. December 31st, 2026. That is the absolute last day you can file a belated return for this assessment year. Once we hit March 31st, 2027, which is the end of the assessment year, the portal won't accept your return at all. That December 31st cutoff, it is a hard, unmoving wall.
So how do you actually do it? Well, the process is surprisingly straightforward and basically identical to filing on time. Step 1, you just log into the income tax portal. Step 2 is where the key difference is. Instead of filing a normal return, you're going to select Section 1394, which is specifically for belated returns. Step 3, before you can actually finalize everything, the system will automatically calculate those penalties we just went over. You have to clear these accrued 234F penalties and the 234A interest before moving forward. Once that's all paid up, step 4 is to simply submit and verify your return just like you normally would.
But, what if absolute disaster struck? What if you were hospitalized, there was a death in the family, or a massive natural disaster prevented you from filing even by that strict December 31st cutoff? Well, the Income Tax Act does have one final lifeline, and it's called the condonation of delay under Section 119(2)(b). Now, this is not automatic at all. You have to submit a formal written application along with solid documentary evidence to your assessing officer or the CBDT, basically proving genuine hardship. If they review your case and approve it, they'll manually grant you permission to file past the final deadline. But remember, this is for extreme cases only, definitely not for simple procrastination. The clock is ticking, right? And the costs of waiting are steep, and especially in the case of your capital losses, entirely permanent. We've walked through the penalties, we've busted the myths, and we've shown you exactly how to fix it if you do fall behind. So the final question for you is, are you going to let procrastination be your biggest tax expense this year? Log on to the portal immediately, stop that financial bleeding, and make sure you're subscribed to our channel so you don't miss our next explainer on the financial rules that silently govern your wealth. Catch you in the next one.